Welcome, everyone. Thank you so much for joining us today for our webinar Exploring Venture Debt and How It Can Be an Option for Startups Out of Academia. I'm Kirsten Leite of Osage University Partners, and I head our university relations efforts here at OUP. I'm going to be moderating our discussion today, but I'm very happy to be joined by two fantastic presenters today. We'll go to the next slide, who both come from banks that do venture debt, Danielle and Larry. I'm going to have them each introduce themselves. Danielle, could you go first?
Sure. And thanks so much for having me. So I'm Danielle O'Neill. I'm on the life sciences team at Banc of California. I have been with the bank about 3 years now, but have spent the past 14 years mainly on the finance side of the life sciences space. So doing equity fundraising, debt fundraising, corporate cash management, and I'm a former founder.
Great. Thanks, Danielle. Larry.
Yeah, thanks, Kirsten. Larry Sherman. I'm a managing director with Western Alliance Bank. I run our California innovation banking practice. I've been here almost 10 years and working in California as a lender with startups and all types of companies for a couple decades, and appreciate you having me here.
Well, we're really glad that both of you are joining us for this exciting topic and one that I think a lot of our startups out of academia don't know much about. So we will be diving into our subject matter in just a little bit. But first, we want to get to a few logistics. So we'll go to the next slide. We will be sending out a recording of this webinar and the deck to all the people who registered for the webinar. That'll probably happen sometime next week, so just wait a few days and to receive that email. We also will have a recording of this webinar both on OUP's partner portal and via our YouTube channel. You can see QR codes for both of those here. For the partner portal, you do need to be at a partner institutions of ours in order to register for that. And on there, it shows on here how you can get to the webinars on when you do register for the partner portal itself. For those of you who are not at our academic institution partners, you can eventually find this on our YouTube channel, which is also noted here. So look for emails, and like it says, later this week or early next week for these recordings themselves. We also do have a couple of upcoming webinars in case you have an interest. On July 15th, we are going to have a webinar about the SBIR STTR reauthorization and some tips and tricks for navigating these funding opportunities. And then on August 19th, we will have a webinar on advisory boards for academic innovation operations. So be looking out for information about how to register for those coming your way soon. So we'll go to the next slide. A little bit about OUP before we dive into our main subject today, and especially for those who don't know us, we're a venture capital fund that partners with academic institutions to invest in their startups, typically by exercising their participation rights available in their licenses. For those of you who don't know what a participation right is, it is the ability to invest in future rounds of a company on the same terms and conditions as other investors. We do have recommended language on participation rights for those of you who don't already have that in your license agreements, and we're always happy to send that out. As a part of this partnership that we have with academic institutions, they share in a portion of our profits, and they also receive programmatic support on tech transfer and academic startups. We're now on our fourth fund here at OUP, and we've been investments in over 150 different companies in all area of deep sciences. And if we go to the next slide, you can see some of those companies that we've invested in and some of the areas in particular that we've invested in both the life sciences and deep tech. We're always happy to talk about our model, so feel free to reach out to us if you have any questions with that. I'll go quickly to the next slide and just note that we do encourage questions throughout our webinars. Please, I will be moderating the questions, so please use the Q&A tool, not the chat tool in the toolbar for Zoom for me to be able to track all of those questions. I know that venture debt may be a new subject for a lot of you, and so it helps me organize the questions after we get through the slides by both Danielle and Larry. So with that, I'm going to pass the mic over to Danielle for her presentation, and she's particularly going to concentrate on venture debt in general, but also in the life sciences area, tech, and Larry will talk some about venture debt in general as well, but give an example of probably for the tech area because it can be used in all area of startups themselves. So with that, Danielle, I'll pass it over to you.
Thanks so much. So yes, as mentioned, I'm going to kind of go over venture debt in the life sciences space, give kind of a high level overview on venture debt, and then we'll get into some case studies. So next slide, please. So again, high level overview. So there's a few different types of venture debt. So there's term loans, there's revolvers, and then there's lines of credit. Folks are probably familiar with lines of credit. Term loan, hence the name, is usually a 4-year term. Revolver also has usually a set term as well, but it almost acts more like a line of credit where you can draw it down and pay it off multiple times. So typically in the life sciences space for therapeutics companies, we're pretty much only doing term loans. And then where there's companies that are actually generating revenue, maybe med tech, diagnostics, healthcare, IT tech, bio, we may then use a revolver structure. And with revolvers, they can also be what's called formula or non-formula. A formula line just means it's based on the availability is based on some metric. So for example, one of the proposals we recently made had the availability based on a multiple of trailing 3 months average monthly revenue. So, and that's also just wanted to note as well, banks aren't the only folks that provide debt funding. Funds also provide debt funding as well. The difference is we collateralize the cash as a bank. So we require that the company moves the majority of the banking relationship to us versus a fund who, they don't have a bank affiliated with them. So they're not collateralizing the cash, and thus the interest rates are typically much higher for a fund. So we talked about term. Interest only period is the period in which a company only pays interest and not the principal. Generally, you'll see that around like 12 to 18 months or so. Draw period is the period where a company can choose to draw the loan. And so some loans will have upfront availability, some will not. Tranche, so you guys are probably familiar with this terminology from equity funding. So we also will sometimes tranche the availability based on certain milestones. Covenant is a requirement that you need to meet to be in compliance with the loan. You may see cash covenants where cash can't fall below debt outstanding. Or, for example, on the milestone side, there may be a clinical milestone covenant. So there's also a number of different fees. Facility fee, which is a nominal fee that you pay at the time that the loan closes, so kind of upfront. Unused fee, a percentage paid on the unused portion of the loan. Prepayment fee is paid if the loan is paid off ahead of time. So we do not usually charge unused facility fees. I should have noted that. A lot of times you'll see the unused facility fee with funds. It's less likely to show up with banks. And then final payment fee paid when the loan ends, and then success fee and warrants, which are paid when the company IPOs or has an M&A event. Next slide, please. So a lot of folks, I'm sure, are interested what we actually are looking for when we're engaging with a company. So I'll say that what we're mostly focused on is kind of the stuff on the left-hand side of this slide. So, really we are underwriting to who the lead investor is. That's like a good, one of the main focuses of us underwriting the loan is who your lead VC is and who else participated in the round. So it's important that the company is backed by institutional VC investors. I'd also say that financial VCs are, favorable over corporate VCs. Corporate VCs are great. They, definitely validate, that there's a potential ultimate buyer. But it could be problematic sometimes if they lead because as many folks know, for example, pharma will get in and out of certain indication areas, and so we want to make sure that the VC that has funded um, in the last round will continue to fund in the subsequent round. Um, and so cash runway is also really, really important. We generally want the company to have at least 12 months of cash runway or more. So again, this is more kind of financial due diligence versus kind of like asset-centric due diligence. So on the cash runway side as well, so ideally we'd like to come in on the heels of an equity round, versus, coming in post equity round when the company has little cash runway. And you can go to the next slide. So these are just some examples of use cases for venture debt. So runway extensions are really good, use case. Having some extra cushion is always very helpful. Balance sheet strength. So when you're negotiating your next equity raise, you're not running out of cash, so you are in a position of strength. Pipeline expansion, CapEx financing, and working AR or inventory smoothing, and then reducing equity dilution as well. So one great part about venture debt funding it is non-dilutive. So very founder friendly, which I think most folks don't really think about. And then also, I think a lot of folks assume that venture capitalists don't like debt funding, but actually, it allows them to bring in some additional capital for the company, right, without diluting them further. So it's kind of a win-win. You can go to the next slide. So again, this reiterates some of the use cases for debt funding, and gives kind of an example of what a common term loan deal would look like for a therapeutics company. So another use case that's mentioned on here that we didn't talk about in the last slide is acquisition. So good use of debt funding is, acquisition of a company or asset. On the acceleration side, we often see that a company, their lead asset will be funded with the equity funding, but perhaps they would like to move forward a secondary asset in the pipeline. So debt funding is a very good use case for, you know, that particular scenario. And so this shows an example of, company raising capital, and then us kicking out the interest only period, which we learned about. In this particular case, we are showing that the company actually ended up drawing on the loan. A lot of times you'll see that will kind of extend the interest only period with the loan undrawn. But usually if we do kick out the interest only period and we give the company an extension on the interest only, we do want to see that they're hitting their milestones, which is the case in this particular example. And also, I guess what is kind of good to note when you're thinking about how venture debt can play a role. So basically, we usually come in at around 20 to 40% of the last equity round typically. So this usually equates to about 3 to 4 months of additional runway, just to give you an idea of, how much time this kind of helps you to buffer. Next slide. And so this is an actual, use case. So last slide was theoretical. So this is a biotech company that raised 100 million in their Series A in the fourth quarter of 2022. We issued them a $25 million term loan in 2024 with 20 million available at close, and then an additional 5 million once they hit milestones. They ended up receiving IND clearance in 2024. They moved into first human trials, and they unlocked the second tranche of the loan. So that, as you recall, 25 million total. So that was an additional 5 million. They had not yet drawn on the loan, and so we extended the interest only period after they hit that milestone. They had positive phase 1 data for their lead program, and we actually ended up extending the interest only period a second time. And then they just raised 150 million Series B in 2025, Early this year, we restructured and upsized the facility to 40 million. This, because you see, they actually never ended up drawing on the loan. So this is a really good example of, this really can be a rainy day kind of insurance policy for the company. Next slide. And so kind of just summarizing, picking the right debt partner. So you just really want to think about whether or not the partner is going to be able to solve for what you're looking for. Do you want to draw on the facility as soon as it closes, or can you wait and have availability delayed? What are the rates and the fees? Again, I'm not sure if I actually mentioned this, but typically for rate, you're going to see prime plus one, that's WSJ prime. So you want to make sure that rates and fees are in line with the market. And then I think probably most importantly, especially in these very technical areas, it's helpful for folks to have an understanding of your technology and what you're actually doing, so they can kind of structure the debt upon milestones that actually make sense for you. And if you are going to look for a larger facility at some point, it's also important to look for a firm that's going to be able to grow with you as well. And that's it on my side.
Great. Thank you, Danielle. Yes, and here's contact information. We'll have also more the contact information again at the end of the slides. Larry, we will move on to your slides if we can go to the next slide.
All right. Thanks, Kirsten, and thanks to Danielle for the great foundation there. Again, I'm Larry Sherman with Western Alliance Bank. So over the next few minutes, I'd like to build on what we've just heard and walk you through how we think about venture debt, what it is, who it's for, how founders benefit, what lenders look for in underwriting, and finally, how to actually get the process started. So let's jump in. Next slide, please. So starting with the basics, and some of this may be a little bit redundant to Danielle's slides. Venture debt is a form of growth capital that's provided by a specialty lender that could be a bank or a fund, and it's offered specifically to venture-backed companies, meaning companies that have already raised institutional equity. There are three key characteristics to note. So first, venture debt complements an equity round. It is not a replacement for equity. Sits alongside it, and it's usually implemented shortly after your priced round closes. Second, it's typically structured as a term loan, a revolving line of credit, or some combination of the two, depending on what the company needs. And third, this is the part founders really care about. It's designed to extend runway without the immediate dilution that comes with raising more equity. Although it is important to note that unlike equity, venture debt is a loan that does eventually need to be repaid. In short, venture debt is structured growth capital for companies that already have credible equity sponsorship. Next slide, please. So why do founders choose venture debt? Three key benefits stand out. First is preserving ownership. So venture debt is the least dilutive form of financing available to a venture-backed company, which means more economic upside is retained by your investors, your founders, and your employees, the people who built the company. Second, extending cash runway. Debt buys a company more time to hit the next business milestone, the next product release, the next revenue inflection point before you have to go back to the equity markets. That timing flexibility often translates directly into a higher valuation at the next equity round. And third, increasing strategic flexibility. Venture debt funds the things that drive enterprise value. That's hiring, R&D, go-to-market investment, and it gives you the optionality around when you raise next. It can allow a company to raise equity from a position of strength with additional cash cushion. So simply put, venture debt can help founders make their equity dollars go further. Next slide, please. Beyond the founder level benefits, there's a broad set of advantages at the company level as well. So Danielle talked about this, but a good venture lender becomes a strategic long-term partner that can scale with the company from Series A all the way through an acquisition or IPO. Debt strengthens the balance sheet, it supports sustainable growth, and it signals discipline and gives the company a financial cushion. It reduces the blended cost of capital because debt is meaningfully cheaper than equity on a fully diluted basis. Closing a venture debt facility also demonstrates confidence, both from your equity investors who supported it and from the lender who underwrote it. That's a credibility signal to the market. And finally, this is something a lot of founders overlook. Bank venture debt commonly is bundled with treasury management and market services as a holistic offering. You get operating accounts, foreign exchange, credit card programs, and other deposit solutions, the full banking infrastructure a venture-backed company needs. Next slide, please. So let's flip the perspective a little bit. What does a venture lender actually look at when underwriting a deal? We'll focus on three key buckets. So first is the company profile. We want to see a venture-backed company with credible institutional investor support and a clear business model and growth strategy. We want to understand where you're going and why. Second, financial considerations. We're going to spend real time on cash runway and burn rate, and we want to see either revenue visibility or a credible path to scale. The math has to work. We need confidence that the company can either reach the next equity round or generate cash flow before the loan matures. And third, investor quality. This is critical in venture debt. Who are your sponsors? What's their reputation? And most importantly, what's the depth of their ongoing support? Venture lenders are not lending against assets the way a traditional bank does. They are partly lending against the strength of the equity story and the people backing it. If a company is strong on these three dimensions, it is likely they can get a deal done. Next slide, please. So if you're looking to start the venture debt process and do not have a prior lender relationship, I recommend you begin by asking your equity investors and advisors who they recommend working with. Step one is usually an initial lender discussion. We start with a conversation. Tell us about the business, your funding history, what you're trying to achieve. It's exploratory and there's no commitment. Step two is underwriting and diligence. We dig into the financials, the investor syndicate, the growth plan. We typically request a data room. We may talk to your lead investors and build our internal credit picture. Step three, credit approval and the term sheet. Once we've cleared our internal credit, we issue a term sheet that outlines the loan structure, size, pricing, covenants, and any milestones. Step four, documentation and funding. Legal documents are drafted, the loan closes, and then we move into ongoing relationship management, which is where the real partnership begins. So from first call to closing, you should generally expect a process to take about 4 to 5 weeks, depending on diligence and legal, though it can move faster when everybody is aligned. Next slide. That wraps up the Western Alliance Bank perspective. Thank you for your time and attention. And again, special thanks to Kirsten and the Osage team for putting this together.
Yeah, absolutely. Happy to. We've got a lot of questions that I have for you. And we do have a question from the audience already. And I think you answered this somewhat, but I'd love to just explore it one more time. So, is venture debt an option for early stage or pre-seed entities spinning out of academic research labs? Um, and from what have been hearing you say, it is usually additive to an equity round that they are raising. But in the case of these very early stage rounds, even if they're doing some sort of equity at that point, does venture debt ever come in at that point? Larry, I'll go with you first, and then Danielle.
Sure. I would say it depends. Although, and I'll speak for Western Alliance, but I'll give a broader view for venture debt. While there are no hard and fast revenue requirements, institutional equity is a requirement. So we typically do want to see that a credible venture fund has invested in the business and ideally has a board seat. And we need to see that clear path to growth, as I said earlier. So I know that's kind of general, but we have provided venture debt to companies that are spinning out of academia. I would say it's a little, the bar is a little higher usually for most companies that are starting out at that very first stage. But I think it's always worth a conversation with a lender. Sometimes venture debt funds will go earlier than banks in that regard because they are able to go farther out on the risk curve. So there could be a situation where you talk to your advisors, your investors, or a banker, and they can point you in the right direction where if a bank can't provide the venture debt that early, it's possible a fund could.
Danielle.
Yeah, and we think about venture debt the same way. We will only come in after a priced equity round, but what's a little bit different for us, working in life sciences, therapeutics companies, pre-revenue, stay pre-revenue most of their life, maybe forever. In that sense, obviously, we don't look to revenue. Again, we are underwriting to who the investors are, and so that's what makes the having the financial VCs invested in you even more important.
Great, thanks. What do you see as the most common reason that companies are taking on venture debt in addition to obviously raising money through a traditional equity financing round? Is it because of a particular facility that they're trying to build? Is it because of a capacity type of thing that they're trying to create, et cetera? I'm curious if you have something that you see as the most common reason that people are taking on this debt in addition to their equity fundraise. Danielle, I'll start with you.
Sure. I think, one of the main reasons is runway extension. Especially for example, in the biotech space, if milestones take longer to achieve than originally anticipate, clinical trials get delayed. You know, I think it's great to kind of have that buffer because I think things unfortunately always take longer than you would like them to. For that reason, runway extension is a very common use case. Again, in the case of therapeutics specifically, a secondary asset, or we're seeing a lot of later stage companies that are using it. If they're looking to go public, they are using it kind of again for runway purposes so that they can kind of like time the IPO.
Yeah, and I'd second that. I think runway extension, generally speaking, is the most common reason. If a founder can raise 2 years of equity in their priced round and then add venture debt, that could give them an extra 6 months, for example, to achieve more milestones and ultimately command a higher valuation at that next round. We do see some specific use cases as well. Heavy CapEx funding could be a use case where equity investors don't necessarily want the company to use equity dollars and they prefer venture debt. And in those cases, it's usually less optionality where the venture debt isn't pulled down. The company actually does usually draw the venture debt in those cases and use it for those CapEx obligations. And then I think probably the third use case that we see would be short-term working capital needs, but that gets into more traditional revolving ABL type structures, such as funding accounts receivable and the short-term working capital needs there, which can also be a side case alongside venture debt.
Absolutely. Okay, great, great answers and more understanding on the use and why people explore this. We have another question from the audience. VCs also provide various strategic non-monetary benefits to a startup, sometimes when they're investing in the company. Do venture debt lenders also play a similar role, or do they primarily make just a financial contribution? Danielle, I'll start with you.
So I would say, I mean, for us, we're also super involved in the life sciences ecosystem generally. So we're definitely providing a lot more than just debt funding. And in addition to the debt, similar to what Larry mentioned, we have cash management services as well. We have credit cards. So there's a lot of other services within the banking world that we offer. And then kind of a lot of the intangibles, I guess, in terms of like making other connections within the industry for you.
Yeah. Larry?
Yeah, I think a lender should be a trusted partner for the long-term solution, and that's not just writing a check, and I know that's where venture investors add a lot of value. I think if you have a good lending relationship, that lender ideally is helping introduce you to others in their world who can provide guidance and insight and further the business. They could be helping with customers. They could be helping with recruiting and placement of key hires that are needed. They could even be helping with ideas around investors for that next equity round. So we try to do all of that when we have companies in our world here at Western Alliance, but I think many other banks and venture funds over or venture lending funds over time have grown to do the same thing.
And I'll just note that, having worked with both of your institutions on various things over the years, that is definitely my experience is actually that it's not just a transactional relationship that you have with your banks these days. And as a startup, you should look beyond just the transactional part. Is what else the bank can offer to you as a startup. And I know that your banks, in particularly, and I'm sure there are lots of others as well, but your banks, I know from long term, have really been involved with the startup ecosystems, and therefore have a lot of resources and connections they can provide. So it was a great question, though. All right, my next question so how commonly is venture debt been used in recent years? Perhaps, we could start off by, I don't know if you're able to provide this, but like numbers of transactions that you typically see per year, or kind of the overall what you see happening in the field. So, Larry, maybe I'll start with you here.
Sure. Yeah, I think it ebbs and flows. Definitely, we follow the heels of venture equity investment. So the more venture rounds that are being done, the busier we are with new company origination. But for us, as I know is the case for Danielle, it doesn't just end with that first transaction. Danielle described kind of the cadence of growing over time. So even on down years when there's less equity, new venture investment, we are very busy expanding with our current customers and growing those facilities over time. In California, which I can speak to the region I cover, we're incredibly busy right now. I'd say Q1 was slower than past years, but Q2 has definitely ramped up, and we are working on a lot of new transactions, which is very exciting. And last year was incredible. It was an up year, I'd say, from 2024 and 2023 as far as new venture debt origination across the board, really, not just in California, but for Western Alliance innovation across the country too.
Yeah, we saw a pickup for sure in interest last year as well. Especially if you think about the market specifically in the life sciences space and in the tech space as well. I think a lot of folks were worried about, follow-on funding. So if they had just raised, they weren't obviously as concerned about that current round, but the next round of funding, right? So essentially having, again, venture debt gives them that cash runway extension, so that if it takes longer to raise that next round, it gives them a little bit of buffer. So I think that's why we saw so many folks interested in venture debt, just because the level of uncertainty was high.
So Danielle, is there a particular area within the life sciences that is most common for venture debt? And then, as an additive to that question, do banks who do venture debt often focus on specific industry areas?
I would say so for us, 60% of the portfolio is in the therapeutic space. It's not saying that therapeutics companies use debt funding more than others. It's just, it's really kind of because of our VC relationships and who we're working with. The majority of our deals end up being biotech. But I will also say that biotech is kind of a different flavor of deals. So, as I mentioned, obviously we are lending to pre-revenue companies. So, not every bank and honestly, not many banks are playing in the therapeutic space. So that's also why we do a lot of deals in the therapeutic space because we don't have, too much competition on that side. But I will say, I mean, I would say most banks are generalists in terms of what area. We just happen to we've been in the therapeutic space since 2005, which is a lot longer than a lot of other folks have been in it. So.
Okay, thanks, Danielle. Larry, any thoughts from Western Alliance on industry areas?
Western Alliance is a generalist. We fund and review companies across all stages, all sectors. We do have a separate life science team from our general innovation team that's run by Bill Wickline, and that is more comparable to Danielle's practice. We also have a separate fund banking group that banks the funds like Osage, and provides those services as well. But if you're talking to a general banker in an innovation practice with us or one of our competitors, you could expect to get someone with expertise to be able to talk about debt and the mechanisms to help a company over its entire life cycle. So I think that's an important question to ask when you're talking to a new lender is what is their level of expertise and can they support them over time, right? And what does that relationship look like over time rather than just right at the beginning? So ideally, you're going to get introduced to a lender that can show you that path and really provide, guidance on how that debt facility can expand over the stages of the company and over the whole life cycle and not have to stop at a certain juncture.
Right. Is there a typical size that you see in your venture debt loans as the companies are taking these on, or is it pretty variable? Larry, I'll start with you.
I think it's variable, but I'd say it's sub $10 million on the earliest stages. Danielle provided guidance, kind of. I think you said, Danielle, that about 30% of the equity round, was a decent size for venture debt. I'd say that's accurate with us as well. So if a company closes, a $10 million priced equity round, roughly $3 million in venture debt would be kind of the thumbnail amount on that. But it can vary. I mean, we've seen some situations recently with aerospace and defense, for example, where massive equity rounds are being closed at very early stages relative to revenue for companies. And then you see these kind of outsized, bolder requests on venture debt that are getting done at the bank level. So I'd say it used to be in the, $3 to $5 million range for the very first venture debt check. But we are seeing kind of outsized requests here and there within certain sectors.
Thanks, Larry. Danielle?
So our deals generally range from as low as 5 million to our largest one in the portfolio is 75 million right now. I will say we can go lower than 5, but that's typically kind of the floor. But I would say a normal deal, the majority of the deals fall within like the 20 to 30 million dollar range. And I will say if companies are looking for like in excess of 80 million or so, usually they're going to a fund versus a bank.
Okay, great. And typically, how long are the loans for? Danielle, go ahead.
Sure. So yeah, so for a term loan, it's usually 4 years. Revolvers also have a term on them. And it's also usually 4 years. We can be flexible with the term, but I would say most of them are around 4.
Larry.
Yeah, I echo that. You can obviously see some situations that are a little bit less or a little bit more, depending on the situation with the company. The other piece that Danielle talked about on their slide with all the terms is the interest-only draw period. So in venture debt, that's a very important term that a founder should pay attention to. Really, what that means is there's a set period of time from the onset of the loan where you can decide whether you want to pull down the debt or not. And most founders will try to size that period to when they anticipate their next equity round is, meaning giving them optionality of being able to pull it down or not. If a bank is forcing or a lender is forcing the company to take a draw really soon out the gate, within the next 6 months, but the founder doesn't want to raise for another year, obviously that's a mismatch, of use because they might not need to pull down the debt and pay that interest expense. So they might want to think about talking to the lender or looking for a lender that can provide a slightly longer draw period to match their use case.
And I think this is known to a lot of folks, but I do just want to have you just speak to it as like where venture debt sits on the stack as far as like, for example, if a company liquidates. Larry, I'll
Yeah,
start with you.
great point. Yeah. So I mentioned this in my presentation, but debt is not equity. We spend a lot of time educating, especially new founders who've never done it before, that it is a different type of instrument, and it does need to be paid back. So venture debt from a bank and usually from a fund is what you call senior secured debt. That means the bank or the lender is going to file a UCC1, that's a lien on all the assets of the company. There could be a negative pledge on IP, meaning they'll set the IP aside, but they have a senior lien on all the other assets. So that's cash, accounts receivable, any fixed assets of the business. And that means that in a liquidation scenario, so a downside scenario, the bank does need to get paid back first, or the lender does need to get paid back first. So that's something that's very important to keep in mind. And that ties into, the underwriting. I think a thoughtful lender should always be really looking for that path to revenue scale and that path to the next equity round or profitability, if that's the company's goal. Because ensuring that there is a high degree of confidence in that path, and we do that in concert by, talking to the investors on the cap table as well, helps ensure that we're underwriting an appropriate amount of debt that doesn't get the company over their skis.
So yeah, so echoing, yes, we sit at the top of the capital stack. We will sometimes allow for like a sub debt lender as well. But we, again, are at the top of the capital stack. And we also do the double negative pledge on IP, which just essentially means you can't pledge your IP elsewhere. That doesn't mean obviously we're gonna block some kind of like pharma BD deal. We're always gonna be happy to see those kinds of things, but just a consideration.
Great. I'd love to talk more about the process and the underwriting. Um, when you're working with these startup companies, who are you typically working with at the startup company for this? Do they often have a CFO or a part-time or an outsourced CFO, or who are you typically working with on this entire process? Danielle, I'll start with you.
Yeah, so kind of all of the above, the CEO, CFO, outsourced CFO. Generally, if there is a CFO, we are working most closely with them. And sometimes you'll see a CEO and a fractional CFO. But yeah, it's generally, I would say, C-suite.
Yep,
Right.
I echo that. Early days, it's usually just the founder, who usually is in the CEO title, or you could have a co-founder who's COO and more, finance inclined. Once a company gets to the Series B stage, I think is generally when they'll try to hire a full-time CFO, and at that point, the bank or lender would be directed to work solely with that person. But prior to that, we do see also a lot of engagement with part-time or fractional CFO firms. Those firms can actually, in my opinion, add a lot of value for a startup because they bring kind of the financial wherewithal and business chops of a CFO without the cost. That's the fractional part. There are people that work for, multiple startups, and I'm sure your investors or advisors have, referrals in that area, but it also can help the lender get more confidence in the financials that they're reviewing if those financials have been prepared by someone who, knows what they're doing and has a lot of experience in running finance and closing the books for startups.
So Danielle, you had talked at the beginning about some very some definitions associated with venture debt.
Mhm.
When founders are dealing with venture debt for the first time, what in particular should they pay the most close attention to that perhaps is going to be new to them, and when they're reviewing the terms associated with this potential venture debt? Like, what are the things that you think they need to be most educated on?
Probably I would say the covenants, and paying attention to those and knowing, what is going to trip a covenant, because you don't want to be out of compliance. I think that's probably one of the most important things. Also, there was a lot of fees that I listed on there. Looking through the fees is also going to be important as well, and kind of figuring out if you're looking at proposals from multiple lenders, figuring out if the lender that maybe is you're looking like your number one is in line with all the other folks as well.
Harry?
Yeah, and I'd say covenants is important to double click on. So a lot of venture debt, early stage venture debt, will have what or is referred to as a no covenant deal in the market. And that just means no financial covenants, meaning the company isn't being held to a certain liquidity level or has to achieve a certain revenue performance or bottom line performance. But in the loan agreement, there are still affirmative and negative covenants that a company has to abide to. So in a typical loan agreement for us, which is about 30 pages, there are things, that a lender says the company cannot do, right? Such as you cannot make an acquisition with 100% of your cash without the lender's consent. And I think it's important that a new founder or CEO, CFO, someone who's new to the venture debt process, really walks through that entire agreement with the lender and has them explain every single feature of the loan agreement to them so that they can plan for the business. There's nothing worse than having a company that has a certain plan and business goals that doesn't align with the agreement, that they signed up to. And so I think it's really important to match the board plan, the financial plan with the credit facility. And of course, things don't always go according to plan, right? These are startups, and you need a lender that's going to be flexible and work with you as well. And I just say along those lines, communication is the number one thing that can help every lending relationship. And I'd say the best startups, the best management teams actually call the lender before they see any reporting, any financial reporting that's turned into that lender, and give them a heads up. Hey, we're going to be light on bookings this quarter, and I just wanted to get ahead of it. And these are the reasons why. And should we be thinking about anything proactively with the loan agreement? Because then if they have a good lending partner, that partner can flag to them, hey, we need to, proactively look at this or look at this. Because as Danielle said, the lender doesn't want the company to go into default with the covenants either, right? They should be both aligned to say, hey, keep the company on track and in good graces with the loan agreement.
Great. Thanks, Larry.
Yeah.
Looking back at the companies that you evaluate, are there characteristics that distinguish the companies that you actually provide venture debt to, and or are there red flags that really cause you to hesitate or decline an opportunity? Larry, I'll start with you.
We've seen a lot of success with repeat founders who've done it before. I know that's not a secret. At the same time, we don't preclude new founders, from taking on venture debt. I just say there is more confirmatory diligence that's kind of done with the investors to say, hey, why did you really underwrite to this founder? Because at the earliest stages, a lot of it is about the founding team for us. And then I'd say, aside from just raising a lot of equity money, the founders that have really been successful have demonstrated not only the ability to build a product that stands out uniquely in the market and is quickly adopted, but also to drive, the culture of their teams to get results. I mean, we've had founders that are dynamic both on product development and cultural team development, which can, enhance their go-to-market strategy and really cause a company to ramp faster. I think if you can find like a special founding team that has both of those aspects, that's usually a good signal to us at the earliest stages. Once companies are later in their development cycle, a lot of times a lender can be brought in. Once a company is at the A, B, or C round, it's a lot easier to just look at the financials, and be able to see the ramp there and know the story. And it's de-risked at that point. But it is harder at the earliest stages.
Absolutely. Yeah. Danielle, same questions about distinguishing characteristics and red flags.
Yes. So similarly, we love repeat founders. I would also say, again, I know we've talked a lot about this, but we base the lending decision on the VC funds that are backing the company. So if it's a fund that has been in the life sciences space for a very, very long time, we're going to be a lot more comfortable with that than somebody who just decided to get into the life sciences space or is a newer fund. And then you also asked about red flags. Similar to what Larry said on the communication side, I would say the red flags are, trying to hide kind of the skeletons in the closet instead of addressing them up front. And so, I like founders that will, be very transparent and kind of communicate any upcoming issues in advance as well.
Yeah, so I think that's a general great lesson overall in the startup area, probably relationships area in general, is transparency and being upfront about things is key, and it will build much stronger relationships with all of your partners down the line. So I have two more questions, no more beyond that. If any of our audience members want to put in any more questions, let us know. One is kind of a future question. How do you, your banks, et cetera, see the future role of venture debt evolving? Are there any changes? I mean, obviously a lot of it depends on the markets themselves, but anything that you can see evolving on this area over the next, few years? Danielle, I'll start with you.
I would just say, like for us, the types of companies that we're looking at has obviously expanded. So, we're seeing a lot of companies that are doing AI-driven drug discovery, which is super cool. We are, seeing companies that are even using quantum to do drug discovery. So, I would say a lot of our deals look more tech-like, but that's just kind of an anecdote in terms of like structure changing. I'm not sure. I wish I had a crystal ball. I'm not sure if structure will be changing in the future, but I would say kind of the industries that we're looking at are expanding.
Thanks, Larry.
Yeah, and I hope this isn't true, but the history would tell me that as venture debt continues to evolve, pricing and terms, I think, will remain very competitive for founders. So, with the regional banking shakeup a few years ago, there became actually more competitors in the space as a result, and pricing. So, things like rate, fees, warrants that Danielle talked about all became better, I'd say, for founders across the board because there were more competitors. So I think there's gonna remain a very healthy market for founders in the venture debt space, meaning they'll just have more options to choose from rather than, one or two only at the top, which is a good thing, for the ecosystem ultimately and founders. And I'd say one thing, if I have a crystal ball, is I would hope and expect that underwriting and processes for venture lenders become streamlined and faster because lenders are adopting AI themselves to be able to streamline their processes and become more efficient. So it's something we're definitely focused on at Western Alliance, and I know a lot of lenders are, and so hopefully founders will experience a faster turnaround and greater efficiencies as they interact with lenders on their venture debt processes.
Yeah, that would be great. We love being efficient as possible in startup companies, right? All the way around. So before I get to my last question, a couple of things. So if you would like to contact our speakers today, we do have their email addresses in the decks that we'll be sending out afterwards. We also have a survey that we'd love for you to complete for us if you are able to. Katie will put that into the chat. Yeah, she just did right now. It will also appear as you leave the webinar today. We really appreciate your responses to these surveys, and we really appreciate your being a part of these webinars whenever we hold them. But your survey responses really do help us determine what we're going to be talking about in the future. And we've been having quite a few of these webinars recently about different forms that startups can receive more capital into them. And this is obviously along that area as well. So we're really delighted, Danielle and Larry, that you were able to join us today. And my last question to each of you is if you could leave our academic startup founders with one key takeaway about venture debt, what would it be? And Danielle, I will start with you.
Oh, it's so hard. I think one key takeaway would be maybe start to think about it before you actually need it. So, we're always happy to talk to founders that are, kind of still forming the Series A, Series B, Series C syndicate. So, always happy to talk to folks earlier. And I feel like, being more proactive is always better, obviously.
Yes, and I will just note that you are both so approachable. Everyone I've met at your banks is so approachable. Just go and talk to them and find out and understand what your optionalities are there. So just to kind of put a point in that, Danielle. Thank you so much, Larry, for you, your key
Yeah,
takeaway.
yeah, I mentioned this in the slide, but I'd say ask your investors, advisors, and even other founders in your network who they like working with, and get those referrals because, that's going to be your best trusted source of information on prior experience of people in your network to go work with a new lender.
Great. Well, thank you both so much. This was incredibly educational. I know it's going to be an educational tool for a long time to come as people explore this area for their own startup companies. Really appreciate you taking the time today to be here to talk about this subject matter. We appreciate our audience being here and asking the questions that they did as well. And we hope that all of you have a good day. Thank you again, Danielle. Thank you, Larry.
Thank you.
Thank you so much.